This is Al Brooks, and this is my price action trading course. This module has to do with trading major trend reversals that fail. Remember the 40-60 rule. All setups have between a 40 to 60% chance of resulting in a profitable trade, and that means you'll lose 40 to 60% of the time, even when you have a great setup. At any given moment, there's an institution taking the opposite side of every trade, and therefore there's a valid bull and bear case on every tick. The assumption is that all institutions are profitable, and that every trade that takes place, every tick that takes place, there's a buyer and there's a seller, so there's a way to make profit as a buyer and as a seller if you manage your trade correctly. When you're looking for a top, you're waiting for a break below the bull trend line and then a moving average test, and then traders will watch the next rally, especially if it's weak. They're expecting the next rally to fail around the prior high, and this would create a major trend reversal setup. So if you have the context, a trend line break, a moving average test, and then a rally testing the old high, and you have a signal bar, then you have a major trend reversal sell setup. Here's an example. We have a strong bull spike and then a channel, which is a much weaker bull trend, and you can draw a trend line below. You can argue that it's a wedge top. We had a failed breakout above the top of the wedge, and the market is starting to reverse down with a second entry short. The sell-off fell below the trend line, and it tested the moving average, and it lasted a lot of bars. So there's reasonable selling pressure in here, enough to make traders think that we might get a more serious reversal after testing the prior high of the bull. Within this bull spike, you can say the bull spike lasted from here to here, and within it there's a smaller spike. A lot of times there are nested patterns within patterns. For example, here's another small bull spike, and again the same channel. So we have a rally, we have a bull breakout, and it's a spike, and there are three little pushes up within it, so there's a micro wedge, and this is a reasonable lower high major trend reversal. It probably does not have a 60% chance of success, but you have to assume it has at least a 40% chance of success because of the 40-60 rule. Everything has between a 40 to 60% chance of success. The sell-off lasted a lot of bars. There were a lot of bear bars in it, so good selling pressure. The signal bar is not all that great. We're in a tight trading range here, so a little bit less reliable, so maybe a 40% chance of success on selling this as a lower high major trend reversal. The initial protective stop is one tick above the signal bar, and the entry is one tick below, and in this case the stop is 66 cents away from the entry price. This is Apple, a 5-minute chart, and right now it's a $600 stock, so even a little bar like this is still 60 cents tall. You enter on this bar, and you have a good looking entry bar, not very big but closing on its low, and then you have a great follow through bar. So now you have a 2-bar reversal. This bear bar is basically totally erasing this bull bar. On some higher time frame chart, maybe a 30-minute chart or a 60-minute chart, this is probably a reversal bar. But look what happened on the very next bar. Okay, a huge bull breakout bar. It went way above the bear bar, and it also went above the signal bar. So if traders relied on a stop above the high of the signal bar, they were stopped out with a 66-cent loss. In general, when you have a good looking entry bar and then a really good follow through bar, most traders would lower their stop to above the high of this very strong bear bar, because if this is the start of a bear trend, the market should not come back above the high of such a strong bear bar. So most traders would have gotten out around break even instead of with the 66 cents loss. Look what followed the bull breakout bar. Immediately a failure, right? A bear bar, a doji, yes, but still a failure. And this is a second entry for a major trend reversal. This time we're a little bit above the top, so you can call it a double top, you can call it a higher high major trend reversal, but it's still a major trend reversal. Doji signal bar, not great. Doji inside bar, not great. And one other big problem with this is this was a surprise move, right? This was a low probability event to completely erase this bear bar. And whenever the market does the lower probability choice, it usually has a second leg up. So we probably will get a second leg up, but even if it's a 55-60% chance of more up, there's still a 40 to 45% chance that this major trend reversal will work and allow traders to get a reward that's at least twice as big as their risk. Traders who took this second entry short, the higher high or double top major trend reversal short, went short one tick below the low of this bar, so they got short on this bar, and their stop is above probably the swing high. There's not much difference between these two bars, but if they put their stop above the swing high, their risk is $1.29. As soon as they got filled, they had problems. First of all, their signal bar is a doji bar following a second doji bar, so that increases the risk of sideways instead of down. And then their entry bar has a big tail sitting above the moving average. We broke above the moving average here. We tried to break below and we reversed up sharply here, and it looks like we're holding above it here. And also this was a low probability event, and low probability events usually have a second leg. So this is not a high probability short. It's probably a 40% short, but with the reward being at least twice the risk, it's still mathematically reasonable to do. Alright, so this is not good. Now we have a little 2-bar reversal here, and a bull body, and it looks like we're holding above the moving average. So we may get a second leg up. The bears, their stop is probably above this bar. They might get out above this bull bar because I think the bulls can make a case that this is a pullback buy from this strong bull breakout. So I think it's okay to exit a short above that bar. This bear bar, by the way, the bulls can argue that it's simply a pullback from this breakout and it's testing the II buy setup. Also, the bulls can argue that these 3 pushes down are a wedge bull flag. This is the breakout, this is the pullback, and it's a breakout test of the buy entry, and therefore it's a buy above the high of this bar. We have another breakout and then another pullback, so another buy signal. You know, the market very often has buy signals while sell signals are active, and that is especially common in trading ranges, and the market has been in a trading range. Actually, you can argue it's been in a trading range all the way back here, so for most of the day it's in a trading range. It's also in a bull channel forming higher highs and lows, but it is in a trading range. Let's take a look at that same sequence, but from the eyes of a bull. So the bulls saw this strong sell-off breaking the trend line, so they're aware that the market broke below the trend line, but they see this as a wedge bull flag, 3 pushes down, and a possible double bottom bull flag with this earlier low, the bottom of the channel. And they have a good looking bull bar, and then an II, a bull II. It's actually an III with a couple bull bars in between. So the bulls would buy above the high of this bull bar, and they have a very good looking entry bar. Their initial stop is below the low of the first signal bar, the swing low, and they're risking about $1.42. They're not all that happy with the follow-through. Tight trading range. Instead of a series of bull bars, you know, they got a tight trading range. And they're certainly not happy with this big bear trend bar. But The market at this point has not hit their stop. After this big bull bar, a lot of traders would move their stop to one tick below its low. I think it's also okay to keep the stop below the higher low. In a bull trend, the market is making a series of higher highs and lows, and the best place for a swing stop is below the most recent higher low. The wider the stop, the higher the probability of success. However, if this is a strong bull trend, it should not fall below the bottom of this strong bull breakout bar. So if you do trail your stop to below its low, your actual risk now is only 27 cents. Okay, we have another strong bull breakout. We have another high above this high and above this high as well. So the bulls will raise their stop to below the most recent higher low, and now this is 15 cents above their entry price. So if they get stopped out, they end up with a 15-cent profit. Late in the day, okay, we're at around 12:30 or so. When you have a big open profit on a trend day, you should be looking for reasons to take your profit, just in case there's a sharp sell-off in the final bars of the day. Here we're getting a parabolic curve, so a parabolic, you can call it a parabolic wedge. We have a spike and 3 pushes up, 1, 2, 3, and we have a good-looking bear reversal bar. To me, this is a reasonable place to take profits below the low of that bar. And if you did, you'd have $7.44 profit with an initial risk of $1.42, and that is an excellent trade. Let me go through the same slides without marks on the chart. So this is the spike up and the channel with possible 3 pushes and a weak sell signal bar. Second entry short below this bear bar. Does not look like a strong sell-off. Good bar for the bears, couple good bars for the bears. Micro double bottom, but after these 2 bear bars, I do not think these 2 bull bars are enough to erase that bearishness. We get some buyers around the moving average. Maybe a small gap bar, maybe the high is slightly below the moving average. Trying to set up a low 2 short with a bear signal bar, but we're getting close to the bottom of the channel, and there may be buyers near the bottom of the channel. Good looking bear bar, but immediately reversed by the next bar. Okay, we got a micro double bottom right here with an inside bar, so that's effectively a small triangle. So the bulls might want to buy this. The bears are expecting that the next leg up will be the last and that we'll get a major trend reversal. Okay, the bears don't want to see that. They want to see a weak leg up to test the prior high. They don't want to see a strong bull breakout. Okay, but this is good for the bears. The market is losing momentum. No follow through after that strong bull breakout. The bulls still think the breakout will succeed, and they think any sell-off here will be simply a pullback from this breakout, and they'll look to buy. Their stop might be below the low of this bar, might be below the recent higher low. Now we got a spike, that little spike, and now we have 3 little pushes up. So we might get a pullback here. The bulls will hope that the pullback is not strong enough to be a reversal, and the bears want the pullback to be strong enough to be the start of a bear trend. They want this to be a lower high major trend reversal. Good start for the bears, but they need follow through. They need to get below the most recent higher low, because otherwise it's still a bull channel. If it continues to form higher highs and lows, it's still a bull trend. At this moment, it's still always in long, but it's also on that major trend reversal short. A very strong bear bar. The bears will probably move their stops to 1 tick above its high. The swing bulls are still long, but they're looking for signs of strength. They do not want the bears to have follow through. For example, they don't want the market to fall below this breakout bar. They do not want the market to fall below the breakout point where the breakout bar occurred. They do not want the market to fall below the most recent higher low. Great bar for the bulls, It turns out the bear bar was simply a test of the bull breakout. Bad bar for the bears. However, weak follow-through after this strong bull reversal. The bears might try another short here. They can argue wedge bear flag, 3 pushes up, 1, 2, 3, and a double top or higher high major trend reversal. For the bulls, they see this as simply a pullback from their breakout, and this is a breakout pullback buy. For the bears, they're not happy with this. They were looking for a strong signal bar or strong entry bar, and instead they got a doji holding above the moving average. This is bad for the bear case. Another bull bar closing on its high. All right. What about this as a higher high major trend reversal? We have 3 pushes up, so there's a wedge bear flag here, and a higher high major trend reversal. But we're getting too many bars up. We're in a 6 or 7 bar bull micro channel, and the entire move up from this low is in a very tight channel. And so there's a lot of buying pressure going on here. Too many bull bars, not enough bearishness, and the signal bar is not all that strong. So to me, I would not take that short. It didn't even trigger. The market rallied higher, and now we're starting to become parabolic. We have the slope between these two highs, and then the slope even gets steeper between these two highs. So this is getting climactic. We're late in the day, and we have a very strong bear signal bar. The channel up is too tight, I think, to be looking for shorts, but it's strong enough, I think, to exit longs. You need to get out before the close of the day if you're day trading, and it's possible we could get a sharp sell-off here. So I think this is a good location to exit longs 1 tick below the low of that strong bear reversal bar. And we got a slight weak bull channel into the close. All right, well, what about when you're looking for a bottom? So if you have a bear trend and then a break above the bear channel, above the bear trend line, and a test of the moving average, traders will look at the next sell-off, especially if it's weak, because it might fail around the prior low, and it might create a major trend reversal buy setup. Here's an example. This is the USO, the ETF that mimics the crude oil futures contract. And we're obviously in a bear trend. We have a bear channel. And the channels are not always perfect. Sometimes the market pokes below the bottom or pokes above the top, yet the channel can continue. So when you're drawing channels, you just look for a best fit and don't worry about perfection. Okay, here you can argue that we have 3 pushes down. You can say 4 or 5 pushes down, but we have a little bear spike, another spike, another spike, a micro double bottom. The market went down and up and down. So we're starting to get some signs of buying pressure. Not a strong signal bar, certainly not after that very big bear bar, but it could lead to a reversal, a test of the bottom of the channel. At a minimum, we should get to the top of the channel. After 3 pushes down in a channel, we probably will get 2 legs sideways to up. To me, this is not a bull reversal. It's not a strong wedge bottom. So if I were buying here, I would only be buying for a scalp. I think the market's still always in short. I think it's better for the bulls to wait for a stronger signal, like maybe a major trend reversal. So if we get a strong rally, bulls will look to buy a pullback. And that's just what happened. We have 6 consecutive bull trend bars, and 2 of them have very big bull bodies. So the bulls are very, very strong here. And we broke well above the moving average, well above the channel, and lots of good buying pressure. So traders will be looking to buy a test of the bear low. The bears, will they short this? It's a gap bar. It's the first gap bar in the bear trend. The first bar with a low above the moving average, and very often that is a good short, but with these 6 bars up, I think the market has switched to always in long, so I'd rather look to buy a pullback. Not all that good for the bulls. You don't want to see a series of bear bars, but that's not a reliable higher low. We have 3 consecutive bear bars. I'd rather buy something that looks stronger. So sellers above, and we got another leg down. We have a bear breakout, 2 bear bars, closed below the lows of the prior bars. But now we have a failed breakout bar. We have a bull inside bar. So the bulls can argue this is a high 2 buy. Here's the high 1, here's the high 2. They're expecting a higher low major trend reversal, and this could be it. But there's too much selling pressure in this move down. The channel is too tight. I think it's better to wait for a second entry. And what about now? We've had 3 pushes down, 1, 2, 3. IIs often become final flags, so this could be a small final flag. This could be a breakout test of the original buy signal, the lowest high of the day. And we also have a strong bull reversal bar closing on its high, a 2-bar reversal. Double bottom, micro double bottom with this bar and that bar. To me, this is a very good looking setup for a higher low major trend reversal. The sell-off lost momentum. We got some buying pressure, and it's a breakout test of the earlier signal. I think this is a strong buy setup. You can call it a wedge bull flag, 3 pushes down. You could call it simply a high 2, 1 push down, and then a second push down that's subdivided. And we have the II final flag and the breakout test. So there are a lot of reasons to buy. Great looking entry bar after a great looking signal bar. So far this is looking very good for the bulls. Okay. The initial stop is 1 tick below the signal bar. Your entry price is 1 tick above. Probability, in this particular case, it's probably better than 50-50 that we're going to rally. So you may not have to go for a target that's 2 times the risk. But if this is a major trend reversal, we should get up at least to this high, test that prior high. And this target, 2 times the initial risk, I think is a reasonable target. So far so good. We're losing steam a little bit. We have a bear reversal bar. The bears want this to be a failed bull breakout. The bulls want it to be simply setting up a pullback from this strong breakout of this bear channel. We don't know yet which. To me, I think the bull case is stronger. Okay, so bear reversal bar, 3 stronger bull bars. And you're still on the long. Protective stop is below the signal bar, maybe below the entry bar. At this point, the entry bar is so strong, I think a lot of traders would raise their stop to 1 tick below its low, because after this strong a bull spike, they'd want the bulls to be in control, and they would not want the market to fall below their entry bar. All right, this is a problem, right? For the bears, if they took the short, betting on more lower highs and lower lows, this is a great looking entry bar, and their stop would be above the high of the signal bar or the entry bar, but they're about the same. For the bulls, they were hoping for just a weak pullback and then a resumption of the trend. So this is not good for the bulls, but they have their stops either below this entry bar or this signal bar to make sure that their losses don't get too big. So we have the bull breakout. The bulls want this to be a pullback and then for the trend to resume. The bears see this bear bar as a failed bull breakout and a resumption of the bear. All right, it fell below the entry bar. It fell below the high of the signal bar. It fell below the signal bar, and it fell below the low of the day. And it did so with 4 big bear bars, each body getting bigger. So the bearish momentum is increasing, and the market probably is now always in short. So the bulls are out. Bears might be selling closes. They might have sold here and then added with each bear close. The bulls, they can argue that maybe we'll get a lower low major trend reversal, but this bear spike is so strong that there probably is going to be at least a second leg down after any kind of a pullback. So 4 consecutive bear bars, the body's getting bigger, so the selling pressure is increasing, and the market at this point is probably always in short, and the bottom, this higher low, failed. Since it was such a high probability trade, that means a lower probability event occurred, and whenever the lower probability event occurs, you always have to be looking for at least a second leg down. So it's probably okay to sell this close, maybe with a stop above the high of the bar, or maybe a stop above any of these other highs. Always in short. Okay, let's say you put your stop above the high of the bar and you sold that close, then your target is down here. Can you use a target 1 times the size of the risk? Yes, because the market just became always in short, and it's probably going lower. Probably means 60%. So if your probability is 60% and you put your stop here, you have a 60% chance of the market reaching your target before it hits your stop. For the bulls, this is a failure. All right, we have a breakout and now a failed breakout. The bear spike is much stronger than this bull reversal bar. The bulls see this as a 2-legged lower low major trend reversal, but I think this is not strong enough to overcome this bear bar, and certainly not strong enough to overcome these 4 bear bars. So there should be sellers above. I would not take that buy. That's a terrible entry bar for the bulls who made the mistake of buying above this bar. For the bears, these 2 bars are simply a pullback from this strong bear spike, this strong bear breakout. I think you can short that close. I think you can short the low one here. But your stop at a minimum is above the high of this bar, maybe all the way above the top of the bear spike. Always in short, therefore high probability, therefore can go for a reward equal to the risk instead of 2 times the risk. Here's the low one short, the breakout pullback short. Decent entry bar for the bears, and you're still on the short from this close. The bears who shorted this low one after this strong bear bar, they might put their stops above its high. They might put their stops above the signal bar high. They may have stops above any of these bear bars. Most bears who took this short, if they took it as a scalp, they're not going to allow pullbacks. And after this bear bar closed and they saw it was a strong bear bar, they probably would put a scalping stop above its high. The swing bears would use a wider stop, like above this strong bear bar, or maybe above the high of the bear spike. So after this bear bar closed, the shorts who shorted below this bar can calculate their actual risk. Their initial risk might have been above the high of this bear bar, and now they see that if they had a stop 1 tick above the high of this bar, they would not have been stopped out. So their actual risk is their entry price, and to the stop that would have allowed them to hold their position 1 tick above the high of this bar, and 2 times that actual risk is down here, which is around 1 time the size of the initial stop from the sell at this close to 1 tick above the high of that bar. Alright, so we have another bull breakout. We had 3 pushes down, 1, 2, 3, a couple bull dojis, so we're starting to get some buying pressure. And we came almost to 2 times the actual risk based upon that low one short. I don't know if we're at the profit target based upon the height of that bear bar, but I do know we're starting to get parabolic. The slope is increasing, and that increases the chances that this is a climactic sell climax and end of the move. For the bulls, they see a bull inside bar after a sell climax, and it's a parabolic sell climax. We're getting late in the day, only a few bars left. You need to take profits before the end of the day if you're a day trader. This would be a good location, 1 tick above the high of this attempt to reverse up, because you don't want to take a chance of a strong bull spike. So if it's making any reasonable attempt to reverse up in the final bars of the day, I would get out. Remember the 40-60 rule or 60-40 rule. All setups have between a 40 and 60% chance of resulting in a profitable trade, and a 40 to 60% chance of losing, even with great setups. And there's always a valid bull and bear argument at any moment. Good trader's equation: both the bulls and the bears can have positive trader's equations, right? Because you can have a positive trader's equation with only a 40% chance of success. That means the opposite side of the trade. Let's say you short and you have a 40% chance of success. The person who sold it to you has a 60% chance of success. So you can have both the bulls and bears simultaneously owning positions with positive trader's equations, because let's say both of them have probabilities less than 50%. As long as they're going for rewards 2 times greater than their risk, they are holding trades that are mathematically sound, reasonable trades. One side will win, the other side will lose, but if they manage their trades correctly and the situation comes up 10 times in a row, both will end up winners. Remember, you're going for a swing trade. When your probability is less than 50% or less, you have to be going for a swing trade. You have to be going for a reward at least twice as big as your risk. And if you do, and even if you lose more than 50% of the time, you'll still make money. Let's go back to this bear channel in the USO and take a look at the bear case. I showed you the bull case. Here's the bear case. We have a very strong breakout, but we have a gap bar above the moving average. The bears see this as just another higher low. Yes, it went above, another lower high. Yes, it went above this high, but it did not yet go above this high. So it may simply be another lower high in a broader channel. So if this starts to churn down, they'll take this bear trend line, instead of anchoring it up here, they'll take this anchor and put it up here, and just look at the whole thing as a possible broader bear channel. All right, so that's what they did. They moved their trend channel line from these highs up to this high and that high, and then look what happened. Remember we had that other reversal down? Well, that other reversal down was at this new trend channel line. It's a failed breakout above the top of the new flatter bear channel. The market at this point, it's in a trading range. The past 30, 40 bars sideways, up and down, and it's confusing. The bulls see a higher low major trend reversal, and they're hoping for a series of higher lows and highs. The bears see this as simply a bear trend that's continuing to form lower highs and lower lows. So the bears took that short. They're viewing it as a reversal down from the top of the channel, and they're going for a risk that's 2 times their reward, which is down here, and they'll look to exit with their profit here. And they obviously got filled. Maybe they'd take half off and then swing the balance, and they'd take the rest off above this little bull bar going into the end of the day. Here's the same series of slides but without notes. Obvious bear channel, lots of selling pressure, not a strong bottom. However, we may be transitioning into a trading range because we're getting rallies. We're stair-stepping down, so we might get up to the moving average. Good for the bulls. Market's probably becoming always in long. Clearly always long. Follow through, definitely always in long. So probably buyers below. You can take the short if you think there's enough room for a scalp, but I think any short at this point is a scalp only because the market's always in long. Another bear bar, not enough of a pullback for the major trend reversal, so I would not take long. There's the trigger on the long, probably sellers above, but will probably go more sideways to down and then form a major trend reversal signal bar. Trying to get a bear breakout, but as long as we're holding above the bottom of that bull spike, I think the market stays always in long. All right, hesitation. 2 legs down, but this second leg down, the 2 bear bars, are stronger than the buy signal bar, so I would not buy yet. For the bears, a failed high 2 attempt and a resumption of the bear trend, but I think we've been in a trading range now for 30 bars maybe, and I don't want to be selling at the bottom of a trading range, especially after the market went always in long on this very strong bull spike. Okay, great looking bull signal bar, possible II final flag, breakout test. You can argue a wedge bull flag. I think this is an excellent buy setup. Great entry bar. Good follow through. Bear bar, not ideal, but still I think always in long, and probably buyers below. The 3-bar bull spike looks more convincing than the bear reversal bar. Swing bears can short this, hoping for another lower high and then another low of the day, new low, and they can see this as a potential channel, a broader channel. We're still forming lower highs and lower lows. They saw this as a double top bear flag. I would not take that short after the 6 strong bull bars. Too much risk of buyers below and a major trend reversal bottom. At this point, you could take this for a swing short, but I still think the odds favor the bulls. Not what the bulls want to see. Clearly not what the bulls want to see, so this is a problem. The market fell below the entry bar for the bulls, and it looks like it's probably going to fall below the signal bar as well. These 3 bear bars, bodies getting bigger in size. Even if the market turns up here, there are probably sellers above. Another very big bear bar. To me, the market's it's always in short at this point, and that bear spike, that 4-bar bear spike, will probably lead to a measured move down. The bulls see this as a large high 2 at the bottom of a trading range. Yes, the market's in a trading range, and we're near the bottom, but this 4 bear bar spike is enough selling pressure for me not to take the first reversal up. I think there probably are sellers above this bar. And there were 3 pushes down, a bull reversal bar. You can argue a high 3. The market went above this bull bar and went above this bull bar. Maybe it's a long above this bar, but the channel down from this high is so tight that I personally would not take the long. If we come up to the moving average around the high of this bar, I might look for a double top bear flag short. We did not even trigger. We broke to the downside again, but now this is the 4th little push down. 1, 2, 3, 4. So this could function as a high 4 buy in a channel, and a lot of times that leads to at least a little rally, maybe up to the moving average. It's late in the day, so for me, I would get out of shorts if it gets above this bar, triggering the high 4. And that's where we closed. We just went sideways into the close. And that's the end of my module on trading major trend reversals when they fail.